Hey everyone, welcome to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week, a lot to discuss. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data and analytics provider. It offers powerful visualization tools on stocks, mutual funds, ETFs, and so much more. Take a look at the show notes for a link to a free trial to YCharts and let them know I sent you to get 20% off when you first sign up for the service. So let's start out by talking about the Fed, of course. And now we have five down. That's five rate hikes this year. And the market's thinking maybe three more to go before the Fed stops hiking rates. And before each and every FOMC meeting, the day before, I put out a tweet saying tomorrow's news today. I did that again before the September meeting here, saying the Fed was likely to hike rates 75 basis points. That's exactly what they did. How did I know that's what they would do? Well, the Fed has done over the last decade and more exactly what the market's been expecting it to do heading into that meeting. So, heading into the meeting, there was an 80% chance that the Fed was going to hike 75 basis points, according to the Fed funds futures market. And that's exactly what the Fed did. So, looking at going forward, what are people thinking? Well, the Fed is not done yet. And if you listen to Jerome Powell in the press conference, he made it pretty clear that the Fed is very dedicated now to fighting inflation, which is a really 180-degree shift from where they were 2 years ago. And it's hard to believe that back then in 2020, the Fed was actually talking about letting inflation run hot. So they wanted higher inflation and they were going to pursue easy money policies for longer, they said, than that was necessary to achieve those higher rates of inflation. So what have we seen in the last 2 years? Well, it's a case of be careful what you wish for, you just might get it. The Fed, not only do they get the higher rates of inflation, it's been much higher than they wanted and much higher than they predicted, as we will talk about in a little bit. So the expectation now from Powell, if you listen to the words, is the Fed is not done yet. There's more work to be done. And the number one job, according to Powell now, he didn't say this a few years ago, is fighting inflation, because without lower inflation rates, there is no prosperity, as we've talked about. So he seems to have gotten the message. I like the language out of Powell. The markets don't like it very much, but this seems to be what's necessary to bring the rate of inflation back down. And the Fed seems to be dedicated to pursuing tighter monetary policy to get us there. So if we look at the Fed funds rate today, 3%. So we're at a range of 3 to 3.25. We started the year at 0.25%. So very quickly getting back to normal kind of interest rates here. And now, if we see continued hikes, which is expected, you're going to see that really shift into a tighter monetary policy regime that we really haven't seen in a long, long time. You have to go back 15 years or so. And so what are the markets expecting? They're expecting the Fed to fasten the pace of their balance sheet reduction. And so, if we look at a chart here of Federal Reserve total assets, we see only a 149 billion decline from the April peak so far. So that's very, very slow. It's kind of a snail's pace. We started the year over here and we're still above that level today. So we haven't even shrunk it on a year to date basis. So the expectation going forward is that the Fed is going to shrink this now at around 95 billion per month. So that would be a meaningful change, and we'll see if they start to do so. They laid out those projections a few months ago and kind of reiterated at this meeting that they were going to follow that plan. And so you'll likely see a faster pace of this reduction. And secondly, in terms of interest rates, the Fed updated their projections in terms of the dot plots as expected, and they're expecting more hikes throughout the end of the year and into early next year. So this is kind of the path the markets are expecting here. They're expecting another 75 basis points at the November meeting, then a 50 basis point hike in December, and then a 25 basis point hike in February of next year. And then after that, the market's kind of saying the Fed will, at least for now, pause and then at some point start cutting rates, as we've talked about in the back half of 2023. And so That would mean that we're very close now to the Fed slowing the pace. So one more 75 basis point hike, if the markets are correct, then we go to 50, then we go to 25, and then the Fed pauses and perhaps even starts cutting rates and in the back half of next year. And so what I'd like to say about these projections, both the market's projections and the Fed's projections, is take it with a grain of salt. They're frequently wrong. They're only really valuable in the very short term, and that's because everything can change if we're looking at a year from now, and likely will change, and that's going to change the Fed's projections, the Fed's language, and everything else. And just an illustration of that is to see what the Fed was thinking 2 years ago in their September meeting, so September 2020, versus what they're talking about today. And it's really been a 180-degree shift. The Fed was thinking that inflation was going to be below 2% this year. And of course, we've seen the highest inflation rate in 40 years. And the Fed back then was thinking they were going to keep the Fed funds rate at 0% for years. And of course, at this point, they've hiked rates already to 3% and are expected to continue to hike rates to above 4% by the end of the year. So take these projections with a grain of salt. The Fed is acknowledging, at least somewhat, that there's likely to be a reduction at some point. They're pointed to 2024. The market's saying it's going to be done earlier, sometime in 2023. And then they still have that longer run Fed funds rate projection of 2.5%. So really, the question is, how much more are they going to hike rates before something really breaks? And we talked about the economy is likely already in a recession, and we'll discuss that a little bit more in a bit. But the Fed is still not acknowledging that outright, and so we're not at the point where the Fed is saying that monetary policy is too tight, given where the economy is, and that's the point likely that the Fed will slow, because right now they're still pointing to a very low unemployment rate, a strong labor market, and still an inflation rate, even though it's come down off its peak, much higher than the Fed wants it. And I think really the Fed doesn't want to be in a situation where they stop or they go too slow and then they're forced to resume hiking in the future. They want to get it right the first time here. And so that's likely to mean, at least in the near term, tighter monetary policy conditions will continue. So what that means for the saver is very good news. We haven't seen savings rates in the U.S. this high since early 2008, and now suddenly there is an alternative. So for years, the rallying cry of the bulls was this TINA acronym. There is no alternative to equities, and so what they were saying essentially was that rates are so low, rates are at 0%. If you want to earn any amount of money on your investments, you have to take risk. You're being forced into riskier assets. And now all of a sudden, very quickly, that game has kind of changed here. And so now we have the first banks that are talking about 3% rates. So these are FDIC insured online savings accounts. You can now get 3% on your money. And if you're willing to lock your money up for longer periods of time, let's say 1 year, 2 years, 3 years, you're going to have 4% rates for the first time in a long time. You got to go back to 2007. So 1 year treasury bonds are yielding 4.15% at the end of last week, 2 year at 420, 3 year at 421. So we haven't seen these types of rates in a long time. So if you have that bucket in terms of your portfolio that you're committed to safety, you now finally can get some return on your money. And that, of course, has been a problem for not only existing stocks and existing risky assets, but that's been a problem for the bond market. So, and we'll talk about that in a little bit. The rise of interest rates, as good as it is for the new entrant coming in, that has been very painful for anybody that's been in an aggregate bond fund or an investment grade corporate bond fund, as we'll talk about. So rising interest rates, good for the saver, ultimately good for the bond investor, because you're going to have higher returns come out of that. But the real downside for higher interest rates really comes from if you have debt, and that debt is renewing now at higher interest rates. And the biggest debtor in the country, of course, is the country itself. If we look at national debt, it's fast approaching 31 trillion. So every day, this is moving higher. And it's expected to continue to move higher. And part of that move higher is going to be the fact that interest rates are making the interest expense on that debt higher and higher each and every month. And this is kind of accelerating very quickly here because a lot of the federal government's debt is short-term debt, so a year or less. And as that's renewing, the federal government needs to borrow at these higher interest rates. So they're no longer borrowing at near 0% rates. They're now having to borrow at these higher interest rates, and the cost on that, if we're looking at a monthly cost on that, is rising very quickly. So every duration of treasuries has gone up. So as all of that matures, the rates have gone up significantly. So if we look at a chart here, I put this together, did the analysis saying over the last 12 months, what is the interest expense on that U.S. public debt outstanding? And this is as of the end of August, $716 billion, which was a record high. And importantly, this doesn't really take into account a lot of the recent increases in interest rates. So this number is a rolling 12-month number. So 12 months ago, interest rates were still very low, and interest expense was still very low. So as those months roll off and we have the more recent interest rate increases filtering in, it's very quickly going to become the biggest line item in the budget. And so right now that is Social Security, which is a little over a trillion in terms of the expense from Social Security. But this is going to, in the next few months, really surge, I think, above $1 trillion and surpass Social Security. So the question that everyone always would ask is, well, why? What's the downside of just continuing to borrow money at a rapid pace? The national debt, which is approaching 31 trillion, was only 23 trillion just 2 years ago in the beginning of 2020. Here we are, almost $8 trillion higher. And the thinking in terms of that increase was it doesn't matter because interest rates are so low and the interest expense is so low, it doesn't matter. But we're very quickly seeing once interest rates start to rise, that debt really starts to matter. And so we're entering a new phase here where the thinking, I think, is going to change in terms of debt and what's the cost on that. Because when you're paying such a high interest rate on that debt, it's going to crowd out the available money from to that can go to other areas in terms of government spending. So that's going to be a discussion that's going to be an important one. And I think in the next few months, as this chart really continues to move up and to the right, it's going to become really a national discussion in terms of how do we handle this and how do we deal with this. And so interest rates, again, good for savers, bad for debtors, very bad for anybody looking to buy a home. And so there's this term in the housing market called house poor, and that's the notion that you're spending such a large percentage of your income on your house that there's nothing really left for anything else. And if we look at what it would cost now to buy the median home based on the median income, that would make most people house poor. And so this is a chart going back to 2006 with data out of the Atlanta Fed. And we see that it now takes 44.5% of the median income to afford the median home price in the US. That's the highest we've ever seen, importantly, higher than the peak that we saw during the last housing bubble. And this is a different way to show that. We've been talking about the affordability every month, just looking at the mortgage payment, but this also incorporates taxes and insurance. So a few other of the housing expenses as well that have been going up very significantly as well. So what this means is housing has become very unaffordable to the average person. And a big part of that has been just the enormous increase in the mortgage rate since the start of the year. So now we have a mortgage rate at 6.29%. That's a 30-year in the US. We haven't seen that mortgage rate that high since October 2008, and it's doubled since the start of the year. So it's starting the year around 3%. We're now over 6%. that's what that does to the mortgage payment calculation. Can't be overstated. It's just crushing. It raises that monthly payment to such a significant amount that it pushes a lot of home buyers out of the market. So they have two choices to make at that point in time. Either they look to buy a lower priced home, which which the monthly payment would be equivalent to that home that they were looking at just a year ago, or they say I'm going to spend just an egregiously high percentage of my income on housing. That's assuming they could get the loan, which is not likely. So most lenders have a cap in terms of what they will lend based on what percentage of your monthly income is going to that mortgage. So it's really, essentially, pushing a lot of people out of the housing market, which is decreasing demand, decreasing transactions. And every month we get more and more data. The housing market index out of NAHB, it's another indicator of this. It was down once again last month. And basically, when it's below 50, this is a poll of home builders. They're saying that more home builders view conditions as poor than good. And importantly, in this report, high percentage, over 20% of builders talked about cutting prices to try to stimulate demand. So how do you make housing more affordable? Well, there's really only two ways to do that. One, you need the mortgage rate to come back down, or two, you need to prices to come down. And so home builders really can't do anything about mortgage rates, but they can cut their prices, and that's what they've been doing to try to get rid of that existing inventory. And so that they're not building as many new houses as well going forward. We also got a report out of the existing home sales, another decline. So we're just seeing a decline pretty much every month this year. It's now at its lowest level since May 2020. And we've talked about this phenomenon where when housing prices peak and you have an affordability crisis, and you have a housing bubble like we saw the last time, prices don't come down immediately. What you see first is transactions plummet. So sellers are not adjusting to that affordability equation that we're talking about. They're still thinking that the home is worth what it was worth, last month, even though it's not affordable anymore. And so instead of reducing their price initially, they just pull the home off the market, where they say I'm not going to sell at this price, and they'll hold on to that price. So transactions plummet until the point where that price starts to come down and there's some meeting between buyers and sellers. And so we're just starting to enter that phase if we're looking at the housing market. The median sales price of the existing home in the US peaked over here in June and is now down around 6%, which is, given the run up, is really nothing. But that 6% 2 month decline is the largest we've seen. You got to go back all the way to 2013. So the rate of change is shifting. The question is, how quickly will home prices kind of revert to some type of mean where it's affordable again to the average person? No one has that answer. But I think most people, as we enter the traditionally slower season for the housing market in the fall and the winter, I think most people are expecting to see continued declines from here. So let's go back to the bond market and talk about what I used to report about the negative yield matrix. So we had this crazy situation for years, and people kind of started to accept it as normal, but I would constantly remind people this is not normal. Being paid to borrow, where you're putting your money in your bank and you're accepting less than a 0% return on your money. And this was really the situation for much of the developed world in Europe. We had 21 countries overall, most of them in developed Europe, with negative interest rates back in 2020. And a lot of these countries started their negative interest rate policy back earlier, and the ECB was in 2014. And it was just a crazy situation where even out to 50 years, Switzerland had a negative 50-year bond. back in 2020. That means an investor was willing to buy this bond and accept a negative return over a 50-year period. Just an incredible thing to see. So again, most of these countries were in Europe. Central bank policy was forcing interest rates to negative levels. And the expectation was they were going to continue to do that for years. And that's why you had bonds out to 10, 20, 30, 50 years being negative. And Japan was among those as well. The Bank of Japan moved to a negative interest rate policy as well. So had this crazy situation 2 years ago. Of course, that was also during the initial stages of the pandemic where everything was shut down. But even before that, in 2019, much of this was negative as well. And then we fast forward to today, and everything's changed in terms of the thinking. We only have one country left, that's Japan, that's holding on to that negative interest rate kind of uh, that negative interest rate mantra that this is actually a good thing. Like this is something we should pursue. The Bank of Japan is really, I think, being stubborn and saying that we're not going to move here, even though everyone else is moving. And you're seeing as a result the Japanese yen there collapse. So um, everybody else has kind of shifted course, and you see the expectations change. So if we look at even Switzerland, they move back to positive rates. Denmark moved back to positive rates. The ECB and all of their countries are back to positive interest rates. And you're seeing the expectations change, not just for short-term rates, but years out as well. So just a huge shift we've seen from back then. And of course, in 2020, US rates hit all time lows again, and they've normalized as well here if we're looking at the shift to today. So, what's amazing is that there's anybody left with negative interest rates. Even inflation in Japan is rising. It's 3%, so not nearly as high as here, but that's the highest they've seen in quite some time. So I suspect at some point they'll be forced to kind of change their thinking and move back to positive interest rates. And so this is much more normal environment, of course, for markets. I always argued for all these years that negative rates was not a good thing. It certainly wasn't a good thing for the banking system, and it's not a good thing overall. There has to be a positive interest rate. There has to be a cost of money for, I think, the financial system to function. And so what's interesting about these charts is it's leading to really a huge shift in currency markets. As you notice here, even though rates have risen across the board around the world, the U.S. Rates are still much higher than the rest of the world, and central bank policy in the U.S. has been much tighter, much faster than developed Europe and in Japan. And as a result, we've seen US dollar index continue to move higher. It's at its highest level now since 2002, up 58% from its low in 2008. So, a very big move in the dollar, and pretty much everything around the world is moving down when measured against the dollar. So, you're looking at the euro, the yen; those are the two major components. They're going down very fast, and British pound has kind of joined that and started moving down pretty significantly in recent months, and it's now at its lowest level since 1985. So just a huge move lower in the British pound relative to the dollar, 46% below where it was in 2007. So big shift. So part of that is the interest rate differential that we've talked about. Bank of England's hiking rates, but not as quickly as the Fed, and not expected to be as aggressive as the Fed. The other part is the economy in the UK seems to be in much worse shape at this point in time than the US economy. If we're looking at retail sales there in the UK, volumes are down year over year now 5 months in a row. That seems to be a recession to me. I don't think they've officially declared it yet, but they likely will at some point. So you have recessionary conditions in the UK, in Europe, and that's pushing down the currencies there as well against the dollar, in addition to that central bank policy. So another headwind for earnings is going to be, as we talked about, that dollar appreciation. We last saw that in the 2014-2015 period, where earnings came down, revenues came down from the businesses in the S&P with overseas earnings. When you have such a strong dollar, bring that back to the U.S. That currency translation, that's a headwind for earnings. So just another factor that's likely putting pressure on markets. And so, speaking of the equity market, we got an interesting report from FedEx, not a very good one, missing on earnings and revenues. And the CEO was interviewed and was asked, essentially, is this a global recession? And his answer pretty much was, I think so. And looking at their impact on businesses around the world, he was kind of making the statement that this is a reflection of a slower global economy in many different areas. So FedEx historically, if we look at their historical drawdowns, has been pretty good, I guess, coincident economic indicator, I guess you could say, when it gets to this point where you're down 50% or more in FedEx stock. Last three times we saw that, the U.S. economy was in a recession all three of those times. So 2020 recession, 2008, 2009 recession, and 91, 92 recession. When FedEx has been down this much, it's been not a good sign for the U.S. economy. It's a sign, tends to be a sign of economic weakness, and we've had that, right? We've had two consecutive quarters of negative real GDP growth, and third quarter GDP isn't out yet, but the expectations seem to keep coming down. I think the last thing I saw at Atlanta Fed was something barely positive. So we'll get that data in sometime in October, the first reading on that. But it's looking more and more like a recession. So in terms of FedEx, this is a charted daily percentage move. So in a single day, I think it was September 16th, it was down 21% recently. What's notable about that, that was the largest decline for FedEx, a one-day decline in history. So it exceeded the decline from Black Monday in 1987. And this sounds familiar. A few months ago, we were talking about Walmart and Target had their largest decline since the 87 crash. So you're just seeing a number of things that we haven't seen in a long time. It's the story of higher volatility that you tend to see during bear markets, during economic contractions. And we haven't seen a market this volatile, with the exception of that brief period in 2020. We haven't seen a market this volatile really since the bear market in 2008 and 2009. So pretty volatile times. Equity market is responding to a number of things, as we talked about. You got pressure from earnings coming down. You have pressure from Fed policy, rising interest rates. You have the ongoing war in Ukraine, and that's impact on food prices. And so you have many different factors here creating headwinds for equity prices. And so for now, the market doesn't seem to be looking ahead to better times. They're still focused on the short term here, and kind of saying the worst is not yet over. And so on that front, we've often talked about that inverted yield curve. We first talked about it in April when the 10s and 2s spread first went negative. But here we are in September, and it's not only still negative, it's getting even more negative. We now have a negative 51 basis point spread between the 10-year over here at 3.69%, the 2-year at 4.20, and that's the most inverted we've seen since April 2000. And so pretty much when the inverted yield curves has happened, you have a lag, and then there's a recession at some point in time. But as we talked about this year, it seems to be that lag is very short term. So we could already be in a recession. It hasn't been declared an official recession, but you have this inverted yield curve in April, you have the economic weakness, and so there wasn't this delay this time around. And why is it becoming more inverted? I think that's an interesting question here. Why is the 10-year not rising as much as the 2-year? Well, it comes back to the market's expectations for the Fed, the market's expectations for how the Fed is going to react to this slowdown in the economy. So what the market is essentially saying here is that in the short term, the Fed is going to raise interest rates above 4%. So shorter term yields are responding to that if we look at 1-year and 2-year treasury yields. But after that, the Fed is going to react in the other direction. And so inflation is going to come down. We'll talk about that at the end here in terms of inflation expectations. And that over the long run, looking at 10-year period, inflation is going to be lower, and Fed policy is not going to be that restrictive. So that's what the market's reacting to here. They're looking at this inversion as predicting that the Fed is going to be tighter in the short run, but after that, going back to an easier monetary policy. So we'll see if that's correct, but that's why you have this crazy situation where 10 years 50 basis points below the 2 year. And in terms of the recession, I put out a poll again asking people, what do you think about the US economy? And these are the results. So most people think the US economy is already in a recession. So we'll do this again in a month and see how it changes, but it seems to be rising pretty much every time I do this, and I've done it a number of times this year, and the number seems to be going upward and upward. And in terms of the yield curve, why is it an important indicator? It tends to be a leading indicator of recessions. And last time since 1980, we've seen that inverted yield curve. We've seen a recession. But again, I suspect when all said and done here, that lead time this time around is going to be very short, perhaps even shorter than what we saw after the 2019 inversion. And then we had, of course, that recession in early 2020. So in terms of the bond market, it's been the worst year for bonds in history. And what does that mean for bond market investors? Better years ahead. And I'll tell you why that's the case. But first, let's look at a table here of the US 10-year Treasury bond, down 15.9% this year. If the year ended today, that would be the worst year in history. Before this year, that would be 2009 with an 11% decline. So that rising interest rate from ultra all-time low levels to where we are today is the cause of this decline. If we look at investment grade bonds, similar situation, rising interest rates from all-time low levels has led to a 16.8% decline in investment grade bonds. We've never seen anything close to that in history going back to 1973. We have data on U.S. investment grade corporate bonds going back to 1973. Nothing even close to this. We've never even seen a 10% decline. We're down 16.8%. So worst year for bonds in history, barring some type of miracle. It's likely to be at year end, still be the worst year in history. But why do I say this is likely to lead to better years ahead? Well, there's a pretty much linear relationship historically between the starting bond yield and future returns, not future short-term returns, future long-term returns. So we look out 7 years from now, and we look at the starting 10-year Treasury bond yield, it's been the single best predictor of future bond returns has been that starting yield. So higher the starting yield, higher the future returns, lower the starting yield, lower the future returns. So when the 10-year Treasury was at 30 basis points back in 2020, that was portending the lowest future returns in history. And how you get to that lowest future return, nobody knows, but the market was very vulnerable at that point to any rise in interest rates. And so how we're getting to that lowest return is a huge decline here. And then at some point in the future, of course, that 10-year Treasury bond will come back to par and pay that 30 basis point roughly yield. But it's been extremely painful in the short run. So going forward, much better return prospect for bonds. So if interest rates don't move anywhere in the next 10 years, you're looking at a return for 10-year bond investor, average bond investor, like 3.5 to 4%, which is the best we've seen in a long time. It's not enormously high. It's not what we saw in the 1980s and for the early part of the 1990s, but it's much better than it was. And if we look at investment grade corporate bonds, that too is the best rate we've seen in a while. It's more than tripled now. We're over 5% for the first time since 2009 on investment grade bonds, more than tripled since we hit an all-time low in investment grade bond yields here in January 2021 at 1.79%. I wrote a piece in late 2020 saying that investment grade bonds in general, really the worst risk reward in history. We had never seen this. It was all risk, no return, that if there was any rise in interest rates from that point in time, it was just going to crush in bond investors because there's no cushion. When interest rates are that low, any rise in interest rates, there's no coupon to cushion the blow. And so if you're coming into the bond market today, you should be thinking this is a much better risk reward. Regardless of what happens in the short term, even if interest rates continue to rise from here, the impact of that won't be as much. And then looking out longer term, 3, 4, 5, 6, 7 years, you're looking at the best returns that we've seen for bond investors that we've seen probably over a decade, the prospective returns going forward. So good news there if you're a bond investor coming in. The bad news, of course, is if you're a bond investor that's been through it this year, it's been a very difficult road, the worst year in history. So I want to end on a positive note, as I like to do. And the positive news, it might seem strange that this continues to be the positive news that I end with, but things are finally moving in the right direction in terms of the inflation front. So everyone's, of course, still talking about inflation. The Fed is still responding to inflation, but actual data on the ground is actually pointing to lower inflation rates to come. So let's run through a few of these examples here. Number one, looking at the market-based inflation expectations. So a big reason why the bond market was getting very nervous on the way up here last year and into early this year was that rise in inflation expectations, market based. So it's the spread between TIPS, Treasury inflation protected securities, and nominal treasuries. And when that spread is widening, you have higher inflation expectations, and bond yields typically respond in kind, and the Fed gets very nervous about these inflation expectations because they're thinking there's a risk of them becoming embedded, and that's going to lead to higher inflation rates to come. But now we're seeing the reverse of this over the last few months, where it's down over 1% from its high. This is looking at 5-year break evens. We're actually now at the lowest levels we've seen for this break even rate in 15 months. So very good sign. The Why is it coming down? A few reasons. We have commodity prices coming down. We have demand coming down because it's likely a global recession. So no, that's not good. But that's the way inflation tends to come down, as we talked about in the 1970s and early 1980s. Both periods it came down with recession. So unfortunately, and I think Powell is starting to acknowledge that, you can't break the back of inflation without incurring some pain. And the pain in this case is going to be a slowdown in the economy. And the result of that has been, for now, lower inflation expectations. So that's a good sign. At some point, when this gets, let's say, below 2%, it's really going to be reflected in the market, I think, in terms of expectations for the Fed, expectations for future rate hikes. And at some point, it will be viewed as a bullish sign. For now, people are ignoring it because monetary policy is still moving in that direction in terms of tightening. So another factor that we like to look at is the global shipping rates. So this is a freight index, and it continues to come down. So we're seeing the lowest levels we've seen, in quite some time. It's down about almost 60% from its peak. So that's a pretty sharp move lower. And again, why is this coming down? Number of reasons. Yes, global slowdown, but presumably the supply chain issues are starting to ease, maybe in part due to that slowdown. So you have less demand to meet. So again, this will start filtering in, I think, to future prices. And then in terms of commodities and crude oil, all of a sudden crude oil has come now down to its lowest level since January. And so almost a 40% decline if we're looking at crude oil futures. That's a pretty big move. And thinking where we were back in March in terms of highest level since 2008, gas prices, of course, thereafter hitting record highs and pushing above $5 a barrel. Now we have the reverse of this. And if we look at the year-over-year change in terms of crude oil, all of a sudden now it's up only 7% year over year, which is below the rate of CPI, 8.3% for the first time since early 2021. So this is going to be reflected in the CPI reports for September, and if it continues thereafter, as those the rollover, looking at the year-over-year rate of change, is going to start shifting in the other direction. And lastly, let's talk about the used car market. I've shown this chart a number of times, but here's an update for September. Remember, used cars were an important leading indicator in 2020, pretending higher inflation rates to come. Nobody wanted to believe it at the time, but I kept pointing to this. This is a crazy phenomenon that we have in terms of the used car prices pushing up at that point that led the overall rate of inflation. And now we're moving in the opposite direction. So over the last 9 months, we've actually seen a 13% decline in used car prices, which is the largest that we've seen. So the expectation should be the rate of inflation is coming down. Is it coming down enough for the Fed to stop hiking altogether? I don't think so. But I think you probably, if we're fast forwarding to that November meeting, that this is going to cause the Fed to kind of change their language, and the expectation is maybe one more 75 basis point hike, then 50 or 25. But again, that could change if we see inflation come down much faster in the next few months. I think that those expectations will come down as well. So we'll end there on a positive note. Thanks everyone for joining me. Have a great week, and we'll see you next time.